people who have been listening to our interviews over time, going back 5 years, I think will understand that a lot of the move that we've seen in gold and silver was merely pent-up price action. The circumstances that are in place today that are propelling gold and silver were in place in 2021 and 2022. But people's expectation of the future is set by their experience in the immediate past. So although the facts were laid out in front of them, they didn't have the courage to act. Gold and silver were coiled springs, and some of the tension has been taken out. It's as simple as that. Now, I need to say to people that most people require, even if they understand a narrative, price action to justify the narrative. And it's wild to see a circumstance where more people want to buy silver at 80 than did at 20. When the price moves from 20 to 80, understand that it is precisely 80% less attractive. That's just the way it works. The easy money is made when you buy based on hate. If there's a popularly held public pretense that's wrong and you bet against it, that's the easiest money financially you can make and the toughest money psychologically that you can make. I believe, Dunnigan, as you and I have discussed many times, that gold and silver continue higher, but probably at a less voracious pace. I believe it not because the price has gone up. That makes it less attractive. I believe it because I believe over 10 years the purchasing power of the US dollar declines by 75%, which is, sadly, very good for the nominal price of gold and silver. So I suspect we'll continue to have good years. If you try to measure the years that we have in the future, by 2025, you will, almost by definition, be disappointed.
For years, silver was ignored, mocked, and written off, and that's exactly when the trade made sense. Rick Rule explains that when silver was trading near $20, it was hated, oversold, and mathematically compelling. The goal was simple: mean reversion. But when silver surged past $75, something critical changed. Not the story, not the enthusiasm, but the arithmetic. A position that doubled with no change in fundamentals instantly became far less attractive, even as more people rushed in. That's the danger phase Rick Rule warns about, when price action validates the narrative but quietly destroys future returns. This is why disciplined investors sell into strength, not because they're wrong, but because they were right.
Also wanted to talk to you about your outlook for and your report on the behavior of the mining equities relative to the metals themselves. You've told us in the past that it's normal for the metals to lead and the equities to follow once the earnings or results related to those equities, related to the metals increases play out. But can you tell us what you have been seeing and what you anticipate in that regards?
Well, the equities certainly have outpaced the metals last year, as one would have expected. What was unusual was that the normal progression, which is that the best of the best miners and the largest miners would move first, followed over sort of a 2-year time frame, eventually by the penny dreadfuls. What happened in 2025 is that the smallest and gamiest of the mining stocks moved too, in very dramatic fashion. The consequence of that is that we have an odd market. The metals moved, the best of the best moved, but not as far as we would have expected, and the rest moved much further than we would have expected. What that's meant for me, personally, was that in October, I sold 25% of my junior stock portfolio, my junior mining portfolio, because I felt that the sector was ahead of itself. I felt, too, that by selling off 25% of my upside, I could eliminate my downside, which seemed like a very good trade. It is a truism that you haven't made the money until you've taken the money. What's probably instructive is what I did with the proceeds. I took half the proceeds and I bought physical gold at a package of 3 senior gold stocks, Franco-Nevada, Wheaton, and Agnico Eagle, which is to say I didn't exit the sector. I just de-risked. I went to beta. Normally in a bull market, you would go from beta to alpha. But as I say, this market short-circuited beta and went straight to alpha. And so I de-risked. Much more recently, last week, I noticed that in my own portfolio, physical silver, which I'd bought on an average of $20 an ounce, had exceeded handily my target. I bought the stuff at 20 because it was hated. And you and I talked about this in an interview 4 or 5 years ago, the fact that silver was absolutely hated and a coiled spring. And I said to you that I thought that silver could handily take out its old nominal high at $50. Well, I was wrong. It took out 75 instead. The fact is that I bought the silver because I thought it was oversold and hated, and I thought it would recover. When my investment objectives were reached, I sold my silver, my physical silver, at least 80% of it. Now, there's a lot of people who are in place in silver, and for them, well, they have nothing to sell. What I have decided, for me personally, is that there's more torque left in the silver stocks, and I have a durable competitive advantage. For me, gold is a savings asset, and I haven't sold any of my gold. I've added to it. Silver is a speculative asset, and I'm a good speculator. So I decided to redeploy my physical silver assets into silver equities and oil and gas, which is to say I've used some of the outside strength that we've seen in the last 3 months to shift my risk focus down rather than up.
That's the next topic that we wanted to discuss with you, because it's interesting, even as a physical precious metals bullion dealer, and I and my sons on our team have seen a dramatic shift from 95% plus of our orders with clients having been purchase orders rather than sellbacks, until recently have seen a significant shift to where maybe now it's 30% sellbacks and 70% purchases. That's a big increase in the portion of sellbacks. Your thoughts, because you're talking about even creating an educational product about the strategies around selling. Maybe you've already covered it in a nutshell with your own actions that you've taken, but perhaps you can let us know what exactly you're thinking going forward about teaching others about principles of selling.
I'm going to do 2 things with the Rule Classroom, and it'll be free. One is teach people how to make a buy template. Every time I buy something, I write myself a memo, 1 or 1.5 page memo. Why I bought it, what could go right, what price movement I think I can expect if things go right, what time frame it'll take, what could go wrong, and what would make me sell it. I review that template at least quarterly, or every time an individual investment has news, to consider that news in the context of my reasons for buying that asset. With regards to silver, as I said, I bought it because at $20, I believed it could go to 50. I believe it would do so in 2 years, which meant that I would enjoy a 2-year double. I was wrong. I enjoyed a 2-year triple or better. But the point is that the position that silver inhabited in my portfolio meant that the reason that I bought silver had occurred, and its utility had occurred. And then I had to think, is that portion of my portfolio, that speculative portion of my portfolio, best reflected in physical silver or best reflected in a different asset class? So teaching people the discipline of putting their buy decision down in writing and establishing a template and a discipline around selling is an important part of keeping the money that you make in a bull market. Most people, Donegan, in this bull market, sadly, will miss it. They'll come on late, they'll ride it up through the blow-off phase, and they'll hold it on the way down. And that's a tragedy. I did that my first bull market. I went from being an extremely wealthy young guy in the middle of that bull market to having a net worth below zero after the end of it. And that's not going to happen to me again. Then, after I've taught people how to construct these templates, I'm going to talk to people about the techniques and the methodologies around selling. Selling a successful investment, a successful speculation, is psychologically much harder than people think it is. This fear of missing out, particularly among our crowd, Dunnigan, if you held unpopular beliefs for 2 or 3 years and received no psychological verification, and all of a sudden you've come to believe yourself to be smart, the psychological verification is often worth as much to people as the money. It is a truism, however, that an investment that's doubled in price with no change in the underlying fundamentals is precisely half as attractive, arithmetically, as it was before it moved. Disciplined selling is a critical component. The idea is that you are supposed to buy low and sell high. That means that you're supposed to buy hate, which is very tough to do, and sell favor, which is equally tough to do. In my days in the brokerage business, I received more complaints about foregone profits than I did absolute losses. And I want to teach people the fact that in investing, there are at least 2 primary sins. One is the sin of omission. The other is the sin of commission. Let me explain that to you. The sin of omission is money that theoretically you could have made that you didn't. The sin of commission is losing money. Let's say that I bought silver at $20 and I sold silver at $75. What did I do? Well, among other things, I made a pretty good return over 2 or 3 years. Let's say that the price of silver goes to 90. Did that make me make less money? Why, no. I already have the money. That's the difference in an error of omission and an error of commission. What happens to people is that they feel good about being in the money. And the price momentum that they see gives intellectual verification to the narrative that they've been introduced to, precisely as the increasing pricing takes away the attractiveness of the narrative. So it's very important that you establish a framework as to why you buy something and what makes you or what might make you sell it, either as a successful speculation or an unsuccessful speculation. What you learn in natural resource businesses or any capital-intensive cyclical business, it's really tough to do. And it takes 10 years at least. But what you learn to do is love-hate. You learn to begin to sell stuff where you have psychological verification in spades, and buy stuff where you have a lot of doubt and the market hates you for doing it. And it's tough to do. It's really, really, really tough to do. But once you've learned how to do it, I've been doing it for about 35 years now, it gets easy because you compare your personal balance sheet with others about you who are less disciplined, and you see that it works.
There's a related question here that was submitted by a viewer named Noah Peachy 877 who says, what sector is most hated right now? And secondly, what stock is the most hated?
There are very few commodity sectors that are hated. Even now with the problems in Venezuela and Iran, even my favorite pariah, oil and gas, is starting to catch a bid. So I've gotten out of the way. The fact that the oil stocks and the oil service stocks are up 15% makes them 15% less attractive to me. And my suspicion is that their favor has a lot to do with people trading the news, which is almost always a losing trade. There are places that are hated. Congo, for some reason, is hated. Russia is hated. Because I have a banking organization, I personally can't invest in Russia, but other people who are less constrained can. I would suggest that sulfide nickel, while not hated, is still underpriced. So I would look at that. Canadian oil and gas is up across the board, but it sells at a discount to oil and gas in other parts of the world. I can't find a stock, although I'm sure they're out there, that is roundly hated and is selling at a substantial discount to what it's worth. I suspect that one such stock might be Rosneft, another might be Gazprom, a third might be Nornickel, and Lukoil, which is to say the Russian supermajor mining and oil and gas companies. My suspicion is that if you're a non-U.S. listener and you can access these stocks either through the Kazakh exchange or through a Swiss broker, that your portfolio will be substantially the better in 5 years for having had the courage to buy hate. As I say, this is a circumstance where, as a consequence of my need to observe the letter and the intent of U.S. regulation, that I can't do that.
You may say that you've already covered this in your preamble discussion about the coiled spring and movement of metals markets and so on. Grace Love Harmony asked, if the dollar is not hyperinflating, why does it look like it is with relation to precious metals? Isn't hyperinflation the historical pattern to minimize the effect of overwhelmingly unpayable debt?
I would argue that the rate of inflation, which, by the way, I define as the rate of the deterioration of the purchasing power of the U.S. dollar, while not at hyperinflation levels, is at levels that are probably triple the levels that are indicated to you by the CPI. And let me explain. The CPI is a construct rather than a measurement, which is to say it's an index that is assembled by the indexers. Among other things, the CPI doesn't include food or fuel when it's inconvenient. If you drive or enjoy lunch, the index is of limited utility to you. I would suggest that the Bureau of Labor Statistics, the people who populate the Bureau of Labor Statistics, don't shop, Dunnigan, where you or I or your listeners shop. A simple thought experiment where you look at the price of a basket of goods and services that you consumed in 2020, and you look at the price of that same basket of goods and services today, will tell you that the 2.5 or 2.6% estimate of the CPI is fiction at best. I believe that inflation, which I define as the deterioration of the purchasing power of the US dollar, is proceeding along at 8 or 9% compounded. Look at the price of gasoline over the last 5 years. Look at property tax. Look at health insurance. Look at groceries. Look at rents. Look at mortgages, which have doubled. Mortgage insurance, which has doubled. And explain to me how the deterioration of the US dollar, the purchasing power of the US dollar, has been at 2.5% compounded. Now, it's interesting that when I talk about the deterioration of the US dollar proceeding at sort of 8% compounded, it's interesting to note that if you look at the gold price in 2000, the year 2000, 25 years ago, and 2025, that the gold price increased by 9% compounded. I would suggest that the price of gold, the nominal price of gold, the US dollar price of gold, is over time a much better gauge of the deterioration of purchasing power than the US dollar, than the CPI. We talked before that the period 2000 to say 2023, mid-2023, was a period in time when the stage was set for gold, but gold didn't respond. What gold has done in the last 2.5 years is it made up for lost time. A much better measure of the performance of gold relative to the purchasing power of the US dollar is over a long period of time, which is to say the year 2000 to 2025, where I would suggest the real rate of deterioration of the US dollar was 5.5 or 6% compounded, and the rate of increase in the nominal quote in gold was 9% compounded.
We've got a question that you may also feel that you've covered about the public's perception of the narrative surrounding why it's important to own gold and silver, and the fact that maybe most of them still haven't taken any action in that regards. Mr. Thespian 4 says, when does the general public figure out that they need gold and silver?
I think now that there is generalist support in the gold and silver market. Nothing like you'll see in 3 or 4 years, but there is generalist support. When you and I first began to talk, Dunnigan, J.P. Morgan Chase suggested that precious metals market share as a percentage of all savings and investment assets combined in the United States was less than 0.5%, which would suggest that the generalist investor couldn't spell gold. If you look back over the last 6 months, never mind the ledger of Dunnigan Kaiser, bullion dealer, but rather you look at broader measures like the flow of funds into ETFs. For the last 6 months, the flow of funds into ETFs has been positive as opposed to negative, which is to say people have been adding. Maybe anecdotally more important is historically in bull markets, when the generalist investor comes in the space, the silver price begins to outpace the gold price. And we saw that changeover occur about 3 months ago. So I would suggest that we do have generalist participation, but we still don't have broad-based participation. Witness another factoid. If you look at the big Wall Street firms, the investment strategists are now saying that gold's going to 5,000. Really, they're talking their book based on history. You know, it's a giveaway. It's a way to get attention. But their mining analysts are using $3,200 or $3,300 gold quotes in doing their earnings estimates. That will tell you something about the lack of favor that gold has even amongst mining analysts. And I can't speak to that. I would tell people that although I sold my physical silver last week, I haven't sold my physical gold. Most people don't own physical gold. It's not like most people have trading positions to trim because they don't have any positions whatsoever. How do you trim nothing, you know? And I would urge people who are interested in this to play back some of the earlier interviews that you and I did about the arithmetic of America, about why I believe that the purchasing power of the US dollar declines by 75% over 10 years. This isn't a number that I drew out of air. It's a number that, while not certain, is, I think, arithmetically sound. I think, too, that it's likely, but not certain, likely based on history, that the gold price mirrors, in nominal terms at least, the deterioration in the purchasing power of the US dollar, suggesting roughly that gold will maintain its purchasing power across a broad basket of goods and services, while the dollar will lose 75% of its purchasing power over 10 years. Does that mean that 2026 is going to be as kind to gold holders as 2025? Unlikely, because you only make up for lost time once. Remember that gold was substantially underowned, substantially underpriced 2 years ago. It was that coiled spring that began to come unsprung. Future moves in the gold price are going to have to be earned by the deterioration of the purchasing power of the US dollar. I would suggest that most of the tension in the spring has been released in this dramatic move that we've seen.
Silver didn't peak because the story broke. It peaked because the math changed. Rick Rule's message is simple but uncomfortable. The easiest money is made buying what's hated, and the hardest discipline is selling when you're finally proven right. When prices rise faster than fundamentals, returns are pulled forward, and risk quietly replaces opportunity. Most investors miss this phase entirely. They arrive late, ride the excitement, and hold through the reversal. Discipline isn't about predicting tops. It's about knowing when the arithmetic no longer favors you. Now that you understand how seasoned investors think about selling into strength, the next thing you need to understand is where risk quietly shifts next. And that's exactly what the next video on this channel breaks down.